Welcome everyone. Today we'll discuss 5 tax tips to help optimize your finances in the second half of 2024. At GWS, our client care teams are gearing up for the second half of the year, which typically includes bringing tax-efficient ideas to our clients. These strategies are essential for maximizing your wealth and minimizing your tax. Today, we're going to review the top 5 tax tips for 2024. Taking advantage of tax loss harvesting, as Chris just mentioned, maximizing retirement plan contributions, utilizing tax bracket management, avoiding the Social Security tax torpedo, and being aware of potential tax law changes. First, we're going to go through tax loss harvesting. Tax loss harvesting involves selling investments that have declined in value to offset gains and from other investments. This strategy helps reduce your overall taxable income. These capital losses can offset capital gains dollar for dollar. What's great is that it doesn't have to be a gain from a portfolio that you generated the loss from. It can be a gain from a real estate property or even another investment portfolio that you manage personally. Plus, if your losses exceed your gains, you can use up to $3,000 of the excess loss to offset ordinary income. Typically, ordinary income rates are higher than capital gain rates, so that's extremely beneficial. On the portfolio management side, strategically selling underperforming investments and carefully selecting replacement assets, you can maintain a portfolio's desired asset allocation while optimizing your tax situation. For tax topic number 2, maximize your retirement contributions. Most years, the IRS increases the amount to be adjusted by inflation that you can contribute to retirement plans. This can be tricky for many employees who have contributions on autopilot. As we enter into the second half of the year, make sure you are set out to maximize your retirement plan contributions before December 31st, as it is extremely beneficial from a tax perspective. For traditional and Roth IRAs, you are able to contribute $7,000, plus, if you're over the age of 50, an additional $1,000. For 401k plans, you can contribute up to $23,000 with an additional $7,500 if you are over the age of 50. For dual income families that both spouses are covered by a 401k plan, this means that you could contribute up to $61,000. If you have unequal incomes, keep in mind that many employers allow you to contribute up to 90 to 100% of your income. For those who are 1099, sole proprietors, single member LLCs, or businesses that don't have employees, a SEP IRA plan may be for you. If you have not already looked into it, this type of plan is for those that are self-employed. It offers a contribution limit of up to 25% of your income, up to $69,000 for 2024. This is a great option for maximizing your retirement tax savings. For tax topic number 3, we have utilizing tax bracket management. For many of our retirees, we look to optimize their tax bracket to reduce taxes. Let's take an example of John and Jane, who live on $120,000 per year. You might assume that in order to generate that income, they would have to pay a significant amount of tax. However, you pull the income from the portfolio makes a huge difference. John and Jane have IRAs, which are in the tax-deferred bucket, and taxable accounts, which are taxed at the capital gains tax rate. Let's assume that for the 2024 tax year, we decide to distribute $30,000 from their IRA and $90,000 from their taxable accounts. Their taxable account has a gain of 75%, therefore they're going to generate $67,500 of capital gains for 2024. While they received $120,000 of funds, their total income would show $97,500 on a tax return. The standard deduction is $32,300, which would make their taxable income $65,200. Remember that taxable income is calculated as their adjusted gross income minus deductions, either itemized or the standard deduction. In addition, there are different tax brackets for capital gains compared to ordinary income. If John and Jane can keep their income under a certain threshold, they may pay 0 tax on their capital gains and have a 0 total federal tax owed. This approach emphasizes the importance of understanding how different income streams and deductions affect your overall tax liability. Notice that in this example, we did not include Social Security income, which will bring me to my next tax tip. Tax topic number 4 is to try to avoid the Social Security tax torpedo. Social Security is actually taxed more efficiently than earned income, as only up to 85% of the Social Security income is taxed. However, it is important to not only manage your income tax brackets, but also the provisional income tax brackets that include Social Security. A tax torpedo is the sharp rise and the sharp fall of marginal tax rate as your income increases. This tax torpedo occurs when other income or distributions impact your provisional income. Your provisional income determines how much of your Social Security income is taxed. Only half of your Social Security income is included in provisional income. Any Roth IRA distributions are not included in provisional income. As your income rises, it pulls more of your Social Security into that taxable income, creating a higher effective tax rate. This means that every dollar of income can have a double impact: taxation of the additional dollar and taxation of another portion of your Social Security benefit. However, once you surpass that threshold, the double impact stops. Be aware of the tax torpedo to avoid offsetting your tax planning efforts. Lastly, tax tip number 5. Be aware of the potential tax law changes that are coming in 2026. Tax deductions and rates are set to revert back to what they were in 2017, adjusted for inflation, in 2026. So what type of planning should you be doing? Well, if you look at this slide, nearly every tax bracket increases. Therefore, you are likely to be paying more tax in 2 years for the same amount of income. If you look, the 12% tax bracket moves to the 15, the 22 moves to the 25, the 24 moves to 28, the 32 moves to 33, and the 37 moves to 39.6. Let's look at an example using our tax planning software. Here we are showing an income projection for the tax year 2024 versus 2026 using current law, which shows that the scheduled increases come into play. As you can see, we show the same exact amount of income earned in these 2 years, the same amount of IRA distributions, the same Social Security income, and the same capital gains. That gets us to a total of $280,500 of total income. The only difference is the year and the tax law, which is in effect. The first difference is that the standard deduction has reduced and exemptions have increased for 2026. This change alone already increases the taxable income amount. Then, by the marginal tax bracket changing to 25% instead of 22%, it increases the total tax by $3,323. Plus, any additional $1,000 of ordinary income would have a 3% tax increase, compounding the tax increase as the income rises. A strategy that can be implemented is to do Roth conversions now to fill up that 22 or 24% tax bracket to pay a lower effective rate than what is projected in 2026. Thank you for joining today. Implementing these strategies can help you optimize your financial situation and reduce your tax liability. If you have any questions, please feel free to reach out. GWS@gatewoodwealth.com.